Inflation is partly transitory, but also, in the words of Peter Costello, stubborn and resistant. And the market was very much believing that it was transitory in line with the central banks, but more recently, they have certainly gone against their belief of any transitory influences in the pressures we're seeing. So now we're in the current market, we see that the market pricing in inflation much more aggressively than even the RBA or the Fed are guiding to. So it's a real change in dynamic in the market, and that has significant implications for particularly fixed rate bonds. US equities have had a pretty terrific run, a good reporting season, are pretty fully valued, and Australia looks to be much better valued in comparison. So running into some of the issues, this is how we've been over the past 2 decades. It has been a wonderful period of deflationary pressures, allowing central banks to keep interest rates at very, very accommodative levels. And then obviously money printing, as you can see on the chart on the right, the balance sheets of reserve banks just continue to rise. So we are still in this environment, but it looks like it is the transition to the next phase. Now, looking at what's been driving it, obviously we've had super loose monetary policy. We've had very loose fiscal policy, particularly out of the US over the past 2 years in response to COVID. And in the chart on the right, you can see the big falls in equities across the globe in various different markets, and then the bounce back that's occurred post-COVID. And we are certainly in almost all markets globally, well and truly above making back the ground from the COVID lows. So the key to this story is very much inflation. It's been absent for near 2 decades. The US CPI, we've seen in 2019 at 2.3%. And then in 2020 with COVID, another deflationary event, it went down to 1.3% and a jump up to 5.7% in the 10 months to October so far this calendar year. Now that's high. It's been very much expected. When you strip out some anomalies to it, they see core inflation as 4.6%. So it certainly has stepped up, particularly in the US, much more so than the rest of the world. So some of the pressures driving this inflation, have been transitory, but we've seen other factors come in and add to it. So while you might have car prices adding to it one quarter, it's airline tickets and oil prices the next. And we believe that you'll eventually see the pent-up demand that is driving a lot of those price pressures will ease, as will the supply chains that are causing it at the other end. So it's a real combination of the two that's driving it to excessive levels at this point in time. We've also had Biden's fiscal policy, which has been rather loose. Now, we've had excessive monetary policy under a Republican government for a number of years, and that hasn't added to any inflationary pressures. But the key point here being is that fiscal policy is much more inflationary than monetary policy. Monetary policy goes into asset values, as where fiscal policy goes into the hands of consumers more likely to spend rather than save or invest it. Now, we have seen in recent times in the US that there are some of the supply pressures are beginning to peak, such as the Baltic Dry Index, and we're seeing some prices come off. So we do believe that it is the peak of hysteria for supply chain pressures, but they will be persistent for at least another 12 months. And then, of course, we've got Fed tapering coming later this month. They've been buying 120 billion worth of securities each month. and they're reducing it by just 15 billion. So it's still a very loose monetary policy. I guess the markets really came to terms with not the beginning of that tapering, but the end of it being brought forward to the middle of next year. And the market's now well aware, and that's the expectations, that it's going to be a 7-month tapering period, which is quite aggressive. And then markets are also factoring in a rate rise, the first one in America, by middle of next year, as soon as the tapering is complete. So it's pretty aggressive expectations from the market in relation to how quickly the Fed is going to act. And I think, just a couple of months ago, it was very relaxed in relation to the expectations for tapering and tightening. So how long can the boom go on? There is certainly pockets of spare capacity in the US labour market, but there is also some tightness as well. And I think that the labour market is becoming increasingly important as an indicator to inflationary pressures. And so certainly an area that we keep a close eye on at the moment. So unemployment is continuing to decline. It's currently 4.6% in America, and it was 3.5% pre-COVID, which was a 50-year low. So there is some slack left in the labour market. Obviously, there's no migration. There is a lot of jobs going. There is a lot of demand for labour. There is a lot of people quitting as well. So what we really need to be seeing is we need to see the participation rate of workers in America increase. So back to work in order to ease the supply chain pressures and therefore ease the inflationary pressures. The US reporting season has pretty much just closed. It was their third quarter, and coming out of COVID, earnings expectations were a little sluggish and perhaps a little conservative. What we saw was 81% of companies beat EPS estimates. They reported 17% growth at the top line at the sales level, and then 39% earnings growth. So they really slimmed down and got leaned up during COVID, and now they're coming out the other side in a strong demand scenario. And we saw on average that the US companies beat EPS estimates by 10.3%, which is a wider margin than average. So a very, very strong US reporting season. It was the third highest year-on-year earnings growth since 2010. So there are also pretty good numbers factored in for the fourth quarter and for the full year. So we are seeing corporate profits in America perform very well as America leads the world out of COVID. Now, looking at what's below the bonnet on the US economy, we've got consumers with record wealth, excess savings, and very low debt burdens in a strong jobs market. And then you have mortgage rates still below 3% and easing material costs, looking to support housing prices. Now, moving on, we saw the third quarter reporting season and the results there, but we're also seeing below the surface where companies are beginning to rebuild inventories, and we're seeing decisions being made whereby companies are making big capital goods investments in their own businesses as they gain more comfort as the economy comes out of COVID. So that's very pleasing to see businesses make those decisions. It shows that there is a degree of confidence from American companies in the decision making and the purchases that they're deciding on. So back in Australia, we're pretty well placed at the moment. We're not quite jumping out as strongly as the US is. We have, closed the vaccine gap to them. We're opening back up. Monetary stimulus has been broadly similar in terms of the percentage of GDP that's been invested by the RBA and the Fed. And then we've seen fiscal stimulus also at a pretty similar level in terms of GDP. When it comes to inflationary pressures, we are far behind. You can see our core CPI is at 2.2%, where the US is at 4.6%. So we've got some catch up yet to do, which certainly puts us in a much better position, and it puts the RBA in a much better position compared to the Fed. So we do see total employment still being below pre-COVID levels, but businesses are wanting to hire, but we need to see that participation once again. We are seeing pockets of wage pressure, particularly around some of the mines in Western Australia, but that is only pockets. Now, the market in Australia is in fact pricing the first rate hike by middle of calendar 22, and then a further 3 rate hikes by the end of calendar 22, which is a very short period of time, and I think far too aggressive. It's gone from a place of being too complacent about rate hikes to a place that's far too aggressive. So a bit of an overreaction is where the market appears to be at this current point in time. Now, what about China? China has really been a different story. They were first in, first out, and recovered. So that's not really the issue with China. It's more their own policies and the effects for structural change that Xi is trying to implement. And so what we're seeing is regulation across education, technology, property, and gaming. These have been happening for a good year. And what they're trying to do is align the private sector's interests with that of the CCP, the Chinese Communist Party. They do have their National Congress in 2022 towards the back end of the year. And then they've got the Beijing Winter Olympics in February of next year. So what is most significant for the Australian market? And that is the forced deleveraging of property developers in China. China has built, its backbone has really been property development. And we've been a beneficiary because property development requires steel production, which requires iron ore. So we've been integral to their growth, but at the moment they are trying to make some structural changes in order to set themselves up for the next 10 years of economic growth. And as part of that policy, they brought in the 3 red lines, which was basically to limit the ability of property developers to grow their credit and to continue gearing up. And there was one company that's really stuck out from that group, and believe it or not, it's their second largest property developer. They only have 4% of the market, so it's a very fragmented market, and 4% is not as big as some companies might be, particularly in our markets here. So what we've got with Evergrande is they are struggling to meet interest payments. They have 300 billion of debt. The markets are pricing in a default. Now that default, I think what you will see, it will become more of a debt restructure rather than the company going into administration. And you'll see the can get kicked down the road all through next year. But the reason why Evergrande is not getting any help from the CCP is that they were very irresponsible. I mean, the 3 red lines came in August last year, and instead of trying to meet them, they went in the opposite direction and sought financing in the US high yield market, which is inevitably one of the parts that's beginning to take them down. They have $19 billion in US high yield debt, where you're looking at around 10% annual coupon payments. That's 1.9 billion in annual interest, which is far too large for any company to be sensible or survive. So we don't think it'll be saved by the CCP. It'll be a debt restructure expected in the first half, maybe the second quarter next year, as they go for their next debt maturity. But the markets will have priced that in. I think they have already. And you would also expect to see some other smaller property developers that are also having trouble also go under any time between now and then. But it's not going to be a major issue for the markets. The markets have come to terms with the risks at play here, and they've largely factored into current pricing across equities and debt. And you'll see that the credit ratings is the lowest you can get from all three major ratings agencies on Evergrande debt. So on to iron ore, which is obviously key to BHP, Rio, Fortescue and more. So those steel production limits from China, we saw Z suggest that they wanted steel production to be flat in 2021 over 2020. And by the halfway point of the year, we were up 11.8%. He then came in, tightened the screws and enforced that policy. And we saw steel mills ordered to lower production. And obviously that's coming in ahead to improve the air quality ahead of the Winter Olympics in Beijing in February. So if we look by the end of September, steel production was only up 2% year on year. So we have done a lot of that hard work in bringing the steel production down, or shall I say Chinese steel mills have done that hard work. And there's not a great deal more of tightening that needs to happen. Very interesting to note that iron ore exports to China remain at 36 to 38.6 million tonnes per month. They have hardly changed. So they've been continuing to buy iron ore at reduced prices while this is all going on and restocking the whole way through the period. Iron ore prices, as I'm sure you're aware, have retreated from $220 US down to $84.50. The cost price for producing iron ore is well below these figures. So our major miners are still making great profits from them, just not as strong as they were for the first half and into July and August of this year. So capacity utilisation at the blast furnaces in China is down to just over 60%. And we view that steel mills will continue to limit those productions up until the Olympics has finished. And this is exactly what we saw just before the 2008 Beijing Summer Olympics. Now, look, one other thing that I do want to mention is that China is very heavily reliant on land transfer fees. So the national government receives land fees, and that is 46% of their national revenue. Now, on local government levels, that's up to 84%. So it is a huge part about how they fund their coffers over in China. So they need the land sales and the property developers are the ones buying them, but they want them to be done at more moderate prices because there was some fairly extensive behaviour going on where property developers were bidding up land sale values to extreme levels and property was coming out of the reach of the ordinary Chinese citizen. So that's what this is all about. So on the other side, iron ore is probably going through a tough time, but lithium is another part of the Australian market that is going through a very good time, and it's held up particularly well over past months. And the battery electric vehicle revolution is here, it's coming, and it's more or less guaranteed. On the right, you can see our lithium demand growth forecast. You'll see the 2020 figure down there at the front at 44. Now that is a fairly small level. We forecast on those numbers that it'll go up 9 times over the next 9 years, or 10 years, sorry. So this is a market at its very early stages, a market that Australia supplies 44% of global lithium. Sounds like iron ore did 20 years ago. And we're seeing huge increases from the demand for battery electric vehicles. We're seeing battery electric vehicles being mandated by governments, particularly across Europe and Asia. And then we're seeing car companies, and now I think pretty much every one of them have battery electric vehicle models coming to market in coming years. As an example, the Tesla Model S battery at a 70 kilowatt hour uses 63 kilograms of lithium carbonate. Now, that is a huge amount. It is a much larger amount that's in everybody's mobile phones. And so that is what's happening that is what's having such a pronounced effect on the lithium market, and sees that tenfold increase over the next decade. Now, all available battery chemistries require lithium, whether it's NCA, LCO, I won't go into the details, but lithium is absolutely essential to all technologies that are portable. Hydrogen storage, well, that is a technology that's only at its very early stages, and it's going to be applicable more to large transport such as shipping and tankers like that. So lithium demand looks very, very good, and I think now the market is well aware of it, but this is what iron ore was 10 to 20 years ago. So it certainly looks very good. We have an abundance of the hard rock spodumene, which is the preferred lithium for the manufacture of lithium hydroxide, which is the highest quality lithium that's starting to be used in the newer batteries in battery electric vehicles. So pleasingly for our portfolios, we've got mineral resources. A big part about why it was introduced to the portfolio was because it is a third lithium, and they have decided to restart their Wodinga lithium mine in the Pilbara. They have one of 3 250,000 tonne per annum processing lines to be restarted in the year ahead. So that is a very large mine that they run with Albemarle, and very pleasing to see that one come online, particularly as the lithium market and the conditions and the demand are certainly growing. So a key part to why we like mineral resources so much. But speaking about stocks that we like and how we go about structuring our portfolios, looking at the growth portfolio, structural growth is key. So whatever happens to markets, if your structural growth story is good enough, it can still survive tougher conditions. Lithium looks like it stacks up very well in that regard, and mineral resources is our play within the portfolio there. In renewable energy, you've got Worley Group and Macquarie, and then in platforms, which is another major structural growth strategy that we employ in the portfolio construction, Hub24. I'm sure you're all familiar with it. It's been a very good performer. He's taking over the platform space with net wealth, and there is still a long runway for growth for them ahead. So strategic assets we also like. Cleanaway has a suite of waste management assets that are totally irreplaceable. And then logistics, Cube Logistics has Moorebank, which they are doing a pretty solid job of filling out. And they are also on the acquisition spree to beef up their operations across the country. So inexpensive quality is something that we're always trying to pick up in the portfolio. Iron ore is obviously that at the moment with the prices, but I think that's only a quarter or so away before we see a correction there. And then CSL's had a bit of a tough time while COVID's been happening, and blood collection in the US has been much lower than in historical standards. So we're seeing a forecast pickup for 2023 earnings for blood plasma for CSL. It's largely gone sideways, and it's a great company, as I'm sure you all know. But the ability to get in at the right time and at good prices is what we're seeing at the moment. So that's a recent introduction to the portfolio. And then we like some defensive growth options. Woolworths is the king of that hill. We like to have companies that perform well in a rising bond yield environment, and the banks have been doing that very well. Energy is another sector, and Santos is the clear number one pick for us in that space. And then there is quality growth. Where can we get a quality company that's growing well, growing market share with market leading products? ResMed is certainly one of those, and Aristocrat. ResMed, interestingly enough, was brought in to the portfolio at about $4. It's recently traded over 40, but inexpensive quality was perhaps where it was brought in to our portfolio and to many of your portfolios when they've had a poor quarter. It's a great company with a great product, but when they have a couple of bad quarters, you can really see a good opportunity to get into these companies. So I'd hope to see most of that across your portfolios. So our model growth portfolio, there's our performance. It's been a good period. The past year, we were up 35.5%, against the market's 28%. But really looking at those numbers, they're more important over the longer term. 16.6% per annum over 2 years and nearly 18% per annum over 3 years. It's certainly been a good period for equities and for our models. So to conclude, the power put, which was first termed the Greenspan put, then the Bernanke put, and the Yellen put. So it's been around for 2 decades or so. That is no longer. In past cycles, we've seen equities make new highs well into the monetary or interest rate tightening cycle. And at the moment, we are still with very ultra accommodative, monetary and fiscal policies. They will tighten with the labour and inflationary pressures that we are seeing. Now, that inflation is partly transitory, but also stubborn and resistant. And the market has gone from very complacent about inflation expectations to an extreme overreaction. Now, the market is neither pricing in a dissipation of those pressures, and that is a possibility that could well play out. If we see returning labour, moderating inflationary pressures and strong corporate profits like we saw in the third quarter US reporting season, then that's a very good combination for equities. So with that, I might go back to you, Lindsay. How are you going over there?
Thanks, Tom. Good. Hannah, I'm not sure where I could see the questions crop up, but I'm going to lead away with one anyway, Tom. So boiling down there on that conclusion page there, obviously there's a lot of talk about inflation and interest rates and things like that. Is if those couple of points there down the bottom play out, the belief there is that the markets aren't going to have the great big hiccup that a few commentators are alluding to. Would that be fair?
Look, it's very easy to be out there at the moment saying inflation's coming. The pressures are there. That's probably a more helpful comment 4 to 6 months ago. But now we're seeing the inflationary pressures come through, and we're seeing the market really overreact. I mean, the possibility of having 4 interest rate rises in the second half of next calendar year, after the RBA goes through its tapering process and then finishes up at the halfway point, and then you have 4 interest rate rises within 6 months, is extreme. Look, markets do this. They overreact one way and then the other. So I imagine it'll settle down in the period ahead. But there's certainly been, we've come through August, September, October, which is historically, seasonally, the weak part of the year. We had, a couple of pieces of new information hit markets, which probably knocked a little bit of confidence out of it. So it's very easy for the market to be suddenly going from one extreme to the other. And I think that the current expectations on bond markets are too aggressive. So the fact that they might unwind, and the fact that you might see businesses return with very solid balance sheets, very lean operating structures, in a good demand scenario with supply chain pressures easing and labour coming in, then it's a very good scenario. And you could find that that takes the market to a new high, and that could continue for a certain period of time. I mean, things always take longer than you expect in markets to happen. And I've never seen in all my years such bunched up expectations in relation to rate rises. Never have I seen them like that. So, I don't think that the RBA's tapering will be able to be finished by next calendar year. So there's a lot there that I think needs to be unpacked, and it's a real example of how it's gone from one extreme to another.
Yep, that's great. That sort of leads into a question here that's come through. So again, to do with interest rates and that sort of things. Any thoughts on the property market and what it may do to prices with, inflationary cost pressures there, as we're hearing about building supplies and also then the interest rate predictions?
Yeah, sure. Look, I mean, we've seen the banks, particularly over the course of November, adjust their fixed rates pretty aggressively. They're doing it, outside of RBA guidance. And obviously bond markets did move wildly throughout the month. So I dare say that, you have seen the lows in the fixed rates. You probably see the lows in the variable rates as well. And to be honest, look, property is not as liquid. We're both risk assets, equities and property, but property is not as liquid. So I dare say that you really want to be able to be mobile in this market. I think property prices at the moment are very high, as are equities, and they've all been driven by the same loose monetary conditions. But it takes you too long to get out of property, as where equities you can make a decision relatively quickly. So whether we have, another 6 months, 18 months in this market conditions, or 2 years, any of those scenarios possible. So, I think it's a good time to be selling property, given the illiquidity that is involved. Otherwise, I'd be locking in rates. And look, now that we've seen the bond markets move and banks repriced, so to be honest, you're looking at probably giving it a moment, but over the next couple of months, you want to lock in your rates, because at the moment, the rates on offer are all adjusted over the course of the past 2 weeks. And I think that, there is potential for that tightness to dissipate a little bit, and then you might get a better fixed rate, but you want to be doing it within the next 6 months.
Cool. Another question here, Tom, is do you think Australia will see the same labour force pressures? So what we've got here is a lack of participation, is probably a good way to describe it, where people are sort of not too fired up about going back into the workforce full time after working from home and those things that have been happening in the US and the UK. We're starting to see that here in Australia.
Yeah, look, I think we are certainly seeing it. There is, time will tell. I mean, we haven't seen any response to it overseas, but I think it's certainly a risk to us as well. So I used to watch the CPI and the PPI religiously and wait up, through the middle of the night for the American releases, and now it's going to be ever more jobs data. So that is the key to how we go through this next phase of the market, and it's a key to allowing the RBA here to be sidelined and not come in and make a change, and then that's good for equities as well as any other risk assets, in that they'll continue to perform in a better environment than if they're being restricted because labour markets are too tight. So haven't seen a huge amount of indication on how we're handling it yet, but in overseas, there's certainly those issues, and so it's a risk that it can present here as well.
Yep. All right. Couple questions here. Where do you find value in investing at the moment when everything seems a bit hot, inflated, or overpriced? Property, equities, rural land, bond markets don't look flash, cash is terrible.
Well, we're still in that dynamic where cash is not returning anything. Bonds are likely negative. So you've got a crowding out of those areas, which we've had for a fair while in cash. The bonds have been great performers for a number of years. And now that is crowding and finding a return. And that could exacerbate prices across property and equities. Look, it is certainly hard to find value on a broad scale. But, you know, we're very keen on trying to find, let's go back to, where have I got it here? Inexpensive quality. So where you get to buy a company at a cheap price, that's a company you can hold on to forever and a day. It's a big player, it's got a great balance sheet, it's going to survive anything, and it's knocking out 10 to 15% yield, just dividend yield. That's what's happening in iron ore at the moment. So you want to buy into something where there is a level of investor unease, and you want to have an opinion that sees the unease as transitory or temporary, and a return to normal eventually will happen. So it's a great way to invest. We're always looking out for opportunities to buy great companies cheaply. And at the moment, CSL and the iron ore is probably some of the best opportunities in that space. There's a lot of other sections where there isn't a great deal of value. But we're still in the same conundrum where we haven't got a rate rise for at least another 7 months at the earliest of expectations. And that might be a lot longer than that. And the returns available in cash are certainly not providing. So everybody with cash will be making the same decision. We're facing the same question, sorry. So, you know, I think you'll see that a lot of those funds will be put to work within risk assets. That's certainly how we see them. They still look good. You've got to remember that in past cycles, we've had the equities peak was well into that interest rate rising cycle, and we are not even 7 months away from the first interest rate rise at the market's early expectations. So there is still some runway to go. We don't know how long it could be, but you know, it could certainly be the case of another year, or it could be more than that.
Cool. All right, Tom, now to wrap it up, we've got our final question here, I think, and run us through the time. So everyone's keen to know this one. If you get your crystal ball out and put it on the table. So if we call the Australian share market at the moment at 7,400, what's your sort of rough prediction over the next 12 months, the end of 2022, where you think it'll be?
Yeah,
up 5,
look,
down 5. Yeah, I know it's a crystal ball, but
yeah, look, thank you for that question. We love those ones. So if you look, we did 35.5%. Market did 28% last year. I'm not calling for that kind of market conditions. You know, at 10 to 15% return on the market, I think a return to more pre-COVID market returns is really where we're at. I think we've seen a lot of recovery, but there are still reasonable returns to be made. Certainly more so than what we're seeing across other asset classes, and expensive if you're in one asset class and missing out on those kind of returns. So I would have the expectation of a 10 to 15% return from Australian equities. International equities, you probably say a similar range, maybe a little bit less. There's a few more risks in that space. And look, there's probably not a great deal else. I don't want to make a prediction for bonds and cash is flat zero. So,
yeah, thank you.
And on our market, so I guess that puts us up towards the 8,000 mark. Yep. Whether it tests that mark, we'll wait and see. But 10 to 15% is probably a reasonable expectation for the period ahead.
That's great thinking, you, and that puts us right on time. So Tom, certainly appreciate that. That was fantastic. Little brief. And for everybody who has joined us online, thank you for your time. And if any questions or queries, please send it through to someone in the Boyce or the Boyce Financial Services team, and look forward to seeing you all next time. Thank you.
Thank you, Lindsay. Thank you, everybody.
Sure. Over to you, Hannah.